All right, welcome to the show. Mitch Goldberg here. Be the boss of your money. It's about taking control of your money, understanding what's happening with your money. Uh, Part of the show is to be, your accountability coach, if you will. I really want to see people succeed. I think if you understand what's happening in markets, both up and down, in particular the stock market, you'll be more likely to stick around as a long-term investor. Now, fortunately, fortunately for me anyway, people of all ages are watching this live stream. I'm getting people in their 20s and 30s. I'm getting people in their 60s and 70s and even above. But it is a joy to do this. And I want you to think in terms of this with your money, that if there's a reason why we say in the financial community that if you if you need money in the next year or two, I'm talking like money for a down payment, even if you're selling your family home or you're buying your first home. If you need money for a new home, because even if you're selling your family home, you still might want to put more money into the new home, for example. An important goal. That money is typically in cash or some kind of cash equivalent, like a money market, checking account, savings account, so that when you have a down market, you're not affected by it. And then you have money in for other savings goals, like you have to do car repairs, home repairs. Maybe you're looking to buy a business, invest in something important to you over the near term. That's where savings goes. And then you have money for an emergency fund. So if all else doesn't work out, you have the emergency fund. Emergency fund and a savings fund are two different things. Okay. I know people like to say save for rainy day. I say emergency fund for rainy day, save for what you know you're going to need it for. Emergency fund is kind of like saving money for things that you don't know what you're going to need it for, but you just have to expect that you'll need it for something. The rest gets invested. So I don't despair when the market goes down. I don't look at it like, oh no, my clients are going to miss their goals. What I could see people really despairing about is if you're an individual stock investor and you bought individual stocks and you just, couldn't stop yourself and you just have too many individual stocks. When stocks go up a lot, it's great, but sometimes the environment changes, the situation changes, and they go down a lot. And then you have to worry, about if these are ever going to recover or not. So individual stocks don't always recover. Time does not always bail you out. I can give you an endless amount of examples of that, but I can't give you any examples of when an index didn't recover. But there's two kinds of investors, right? So I have no problem with index investing. I have clients who use index funds all the time because I'm the one who builds their portfolios. Nothing wrong with it. I have clients who are in individual stocks. Most clients have a mix. Maybe they have their large cap individual stocks mixed in with some small cap index or mid cap index, what have you. That's how we do it here. And I also use the same as tools, the same S&P 500 funds you use, the SPY or the VOO. So it's just we all use the tools, but some people I think can, if you give me a set of tools, I'm not going to be able to build you a house. Someone else, you give them a set of tools, they can build you a beautiful house. So it really depends on how you use the tools. Anyway, here's the intro and we'll get into it. I really want to talk to you about the market today. Here we go. All right. By the way, you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. Let's take a look at how the market did today. There's not too many great things you could say. It's not like there was, lately we've been seeing a trend of indexes that have a lot of exposure to technology, the Nasdaq and the S&P getting pounded while the Dow goes down also, but not nearly as much, and the small caps go up. Today, everything just got absolutely pounded. The Dow is down over 1%. I always say, 1% move in a major index definitely gets my attention. 2%, I'm definitely looking. I want to know what's going on. Okay. I always want to know what's going on, but 1% moves or less don't really get me too tied up. But over once you get over 1%, especially the 2%, that's going to really get my attention. NASDAQ was down 3.64%. That is a really big down day. I think this is the biggest down day in the NASDAQ in probably over a year. I don't know. I'm sure we'll read an article somewhere that is, will say it's the worst day since 2022 or 2020 for the Nasdaq. But regardless, it was a really tough day for the Nasdaq. Tough day for the S&P 500, down over 2%. Gold off a little bit below 2,400. Oil in the high 70s. U.S. 10-year. Even when the market goes down, you would expect people to put money to bonds, which would drive interest rates lower. But people took money out of bonds as well. It's hard to really figure out where the money went. And let's just take a look at this. The Russell 2000, that's a small cap index. That was down over 2% also. So small cap stocks, which have been viewed as like, rocket fuel the last couple of weeks, also got pounded. And let's take a look at a few other things. Even like industrials, which really just got absolutely smashed today. You'll still find winners. Lockheed Martin with a very big earnings report, but they are unique industrial company because they're a defense contractor, up 13. UPS got crushed yesterday. You see that red line? It's way below its high. It was just mauled yesterday. So it had a couple of cents uptick today, a little bit of a rebound. But everything else is down. John Deere, but some of the big ones that you have gotten comfortable with, Honeywell was down over $3. But some of them, like I'm looking for Eaton Corp. Eaton was down $22 a share. GE was down almost $10 a share. So some of the biggest names in industrials that have been doing the best are the ones that got hit the hardest. And we could say this with a lot of different areas, but if you look at sector ETFs, technology was down the most, down 4%, a little over 4% of the tech ETF. That's a lot. That is a lot for the tech sector, even for the tech sector. But consumer discretionary down over 4%. There were sectors, materials, financials, consumer staples down, but energy, healthcare, and utilities are up. Utilities are up over 1%. With the draw of the gravitational pull, downward pull of stocks, the fact that utilities are still able to rally over 1% is pretty good. And utilities continue to be a strong player because our electricity usage is still going up, not just from Bitcoin and EVs, but from artificial intelligence and other applications. We are just going to need more computing power, which takes up more electricity. So a bright spot there, but it was really tough to find bright spots anywhere in the market. So this brings us to portfolio construction. Generally speaking, if somebody comes to me and they have NVIDIA and now they don't know what to do with it because they probably bought it pretty recently, and even if they bought it a while ago, they're seeing their gains start to disappear and they're starting to wonder, maybe, I should sell it, because even up to 2 weeks ago, people were still saying to me, I think I should buy more NVIDIA. Artificial intelligence is going to be huge. But the market cap value that was created in the stock market is trillions of dollars. So it's probably worth more than what the profits that are going to be generated from artificial intelligence down the road. That means stocks have gotten way ahead of themselves, if you believe that. Or maybe this is just a temporary reprieve. I think a lot of the artificial intelligence hype, we've talked about this, is pixie dust. And right now, no one's really come out with anything great in artificial intelligence. It's not like every company is using artificial intelligence to build their business or manage their business or improve their business. It's basically a lot of spending. The artificial intelligence stocks has been a lot of spending by the super mega cap tech stocks, because these companies have been throwing off so much cash flow that these are the ones who could afford to invest in NVIDIA chips, their Blackwell chip and their other chips that they have coming out. So, you take those away, where's the spending coming from in artificial intelligence? It's not nearly as great as you think without these top companies. I'm not saying that that doesn't exist. It exists, the spending that they're doing. But I think people are starting to think in terms of eventually someone like a Meta, for example, which is Facebook, could say, NVIDIA, we've been buying a lot of these chips, but we have to slow down the purchase of our chips or stop them because we really just need to work with what we have and see if we could actually design something that can generate a profit. So, yeah, those chips you're going to send us, you take them back. We don't need them now. That should happen in 2000 with like companies like PMC Sierra and other uh, chip companies. And I could, you know, and I could see it happening now. So, it's just a couple of companies that are, it's not just, but it's a lot of the technology move in artificial, a lot of the stock movement in AI stocks is from a handful of companies, the Metas, the Alphabets, that are spending a lot of money to develop artificial intelligence, but we're not even sure what they're developing it for yet or what they want to get out of it and who's it for. But it's not like the buyers of that technology, like a Walmart or a Target or a Toyota or somebody will come to these companies and say, "Hey, that artificial intelligence technology you've developed? Yeah, we want it. We'll pay you whatever we can, whatever it takes to get that artificial intelligence." Nobody's doing that yet. So, with the trillions of dollars of value created in market cap in these stocks, it could be worth more than the opportunity itself from artificial intelligence. And investors take note and they're saying, "This is crazy. I still have some huge gains. I'm going to take them." And we saw just tech stocks getting crushed. And that's been an ongoing theme for, a couple of weeks now, but it does appear to be uh, it does appear to be accelerating. Yeah, we had a nice bounce back yesterday, but it does appear to be accelerating. But every time these stocks bounce back, investors will say, not necessarily you, but a lot of investors will say, "Oh, wait, now they're coming back. I feel relief. I'll be okay now." And then they'll go down, and then investors will say, "I could have sold them when they were higher, so I'm going to wait till they go back." And they go lower, and they go, "Darn, I should have sold, but I'm going to wait for them to go back." And then they go up a little bit, and then investors say, "Well, they're going up now. I'm going to sell them, and I won't sell them until they go higher." And then they go down again. It becomes endless procrastination, and there's no discipline, there's no strategy in deciding how you would take a profit in a stock. It's selling a stock is pretty important. It's not just about buying a stock. So this is what I see happening now, and investors are really wrestling with this notion or with this decision of what to do with some of their biggest winners. There's a company called Super Microcomputer. It's been a hot artificial intelligence stock. It was like over 1,200. Last I looked earlier today was in the 700s. So it's almost a 50% loss in a very short amount of time. And that was considered like a hot AI stock that investors were buying. Don't get caught up in hype. If you did, you could still make some changes. We have we have somebody out there, Daryl. Hey man, Daryl says, "Great stuff, Mitch. In my opinion, the purchasers of those chips in AI gear will be in healthcare and robotics." Well, I could see those as really, good use cases, but still, it's going to take a very long time to get there. If you look at the 2000 tech wreck, when the internet bubble finally burst in 2000, early 2000, we did get there. We surpassed all expectations with all use cases with the internet and how big it would be. But there was so much value created in the stocks that they were so far ahead of the curve that they had to go down until the technology usage actually caught up. Plus, we didn't know who was going to be the standard bearers. I mean, today the internet is dominated by three companies. It's all Microsoft, it's all Google, it's all Facebook. But back in 2000, Facebook and Google did not even exist yet. The leaders of the tech sector back in the day were AOL, Netscape. AOL actually bought Netscape or merged with Netscape eventually. Yahoo. Those were the Yahoo and others, the favorites of the day. really don't even exist anymore except in name only. Okay, so that is the story. Not a lot of great things to say about the day as far as investing, but it is just another day. Do I expect more down days like this? Yeah, why not? I mean, if stock, a lot of these stocks, if a lot of these stocks, I say a lot of these stocks, if a lot of these stocks go down another 20, 30%, they will probably still be up a lot this year. So, you know, not all is lost. We'll be okay. But just remember, if you're going to play in the world of individual stocks, it's really important to have a sell discipline because the buy and hold forever to me is really a matter of when things are going great. People are like, oh, I love that company. It's the greatest stock. They've got this. They're going to do that. They've got this new chip. And people start to defend a stock like Nvidia, for example, because it's got this and it's got that. And they go on to have this long list of things. And then I say, yeah, but it's worth $3.15 trillion recently, plus all the other trillions of dollars of all the other companies in AI. Is it worth that much money? Is the value of these stocks way ahead of the opportunity that's going to be present, that we hope will be presented, hope in a couple of years. And then the profit taking starts. Once it starts, it's hard to stop it. And I think that's why a lot of investors are nervous because they know they either have to buckle in pretty good for this bumpy ride or bail out now and maybe try to buy back later. It's a really tough decision. And that's why a disciplined strategy works. Have a great day. One more from the D Man. A long time is okay to get there. What I've learned from you, thank you, sir. What I've learned from you is that investing is a marathon, not a sprint. Yours truly, the creative thought scientist. Love listening to you. Soak it in, my friend. Thank you very much, Darrell. I really appreciate the vote of confidence. And I'm going to get going. I'll speak to you guys hopefully with better news soon. But regardless, I will be giving it to you straight. Thanks.